Everyone, welcome back to another First Equity podcast. Been quite a while since we did one, probably since on the other side of COVID, and the landscape's definitely changed. So I'm here today with Cory and Christian. I'm Anthony, and just wanted to touch on the rental loans that we've been doing quite a bit of, and particularly debt coverage ratios, because that's a big component of financing rental properties, and that's probably been the lion's share of our business as of late.
Sure. Yeah, absolutely. I mean, it seems like the landscape has changed and fix and flips have become a little bit harder to come by these days. It's hard for investors to find a good viable project, and it looks like people are interested with rents increasing and people wanting to focus on their long-term plan of owning rental properties. That product has become really, really popular. Like you said, it's been the bulk of our business as of late.
Yeah, or even whereas people used to be doing buy, fix, and flip. The strategy, that BRRRR method has become even more prevalent after COVID, or just buying rental properties straight out. So, we have a perfect product for it. And, one of the major factors is calculating that debt coverage ratio. And it's pretty often misunderstood, I think, as far as investors understanding what that number means and why it's important.
Yeah, sure. And I think it's helpful for our listeners to get a better understanding of like the difference of that product versus a conventional loan and why this product has become so popular. And, my background being more in that conventional lending space, the focus has always been, tax returns, looking at people's global financial picture and not focusing just as much on that individual product. And I feel like this product finally gets things right as it pertains to investment properties. And we look at, essentially, we want to see credit score, we want to see down payment, or we want to see equity in the property. But the big focus is making sure that the rent carries the debt on that property, and I think that's a logical way to kind of underwrite these assets.
And then, prior to these, which by the way, these DSCR loans never really got a chance to take off, I feel, because as it became, the marketplace really found this product, COVID hit, and just nobody was doing it. That market totally seized up.
Yeah.
But from like a conventional standpoint, if you don't, without this product and without going to like a local community bank or something like that, conventionally getting one of these done is...
Yeah, it's so tough. One, Fannie, Freddie, bulk lenders will not let you keep a property name of an LLC, which is a huge thing for, our investor base that wants that, wants themselves covered from a liability perspective, that, these loans don't report on your personal credit. That's a big thing for people. And, let's be honest, a lot of savvy real estate investors have a lot of things going on. They got a lot on their plate, a lot of moving parts. They have multiple LLCs and different businesses going on. And that's just it's just a nightmare in terms of how Fannie and Freddie conventionally, underwrite those type of loans. And then, as you guys know, Fannie and Freddie made an announcement recently that they feel they're taking on too much of investment property and second homes and don't really feel that they should be taking on all that business. And they're kind of, in my opinion, I think kind of trying to push other private money to come to the marketplace. So what they did was they recently said, out of if more than a certain percentage of loans that a lender delivers to Fannie and Freddie on a monthly basis, if too much of it is an investment property or second home, they're going to make a pricing adjustment across your full book of business of the loans that you deliver to them on a monthly basis. So as a way to kind of handle that, lenders in the conventional space are trying to figure out how they should price their investment property loans when they go out to their, either brokers or to their loan officers. And just to be err on the side of caution, they've just made the interest rates a lot higher on conventional loans in the short term. And I don't think that that's going to change anytime soon. So now the pricing disconnect where I feel like interest rates, they're a little bit higher on these DSCR loans because, they're a little bit more risk and less underwriting. But now the bridge is, you guys are more on the, talking to individual borrowers. It's not even that much of a difference.
The conversation when this product first came out, and for the right borrower, this was at any rate, was a slam dunk. It was like, you mean I could keep it in an LLC? You mean you don't need my tax returns or W-2s or my income or anything like that? I'm in. And these aren't hard money rates. These are really aggressive, competitive rates. 2 years ago, the borrower would make a judgment call and say, okay, 2% higher than what I may or may not even be able to qualify for with Fannie or Freddie, I'll take that. Mm-hmm. But now, as you said, the rates have come down so much. I don't even know if there is a big gap between what you can get conventionally versus this product.
Maybe it's 100 basis point spread, you think?
And on certain scenarios, I think that these loans probably have higher leverage, particularly on multifamily properties.
Yeah, the multifamily cash out and purchases, we're doing, 80% on purchases, 75 cash out. I mean, that's higher than Fannie will go. And even the community banks, I mean, they'll probably, cap you at 70%.
I know you love this question. Like, what are rates conventionally on? I mean, I kind of know what they are.
Yeah. I mean, again, like you start layering in, I don't love talking about actual rates on these because, historically speaking, if people are watching this down the road, I mean, it's kind of tough to say, but I mean, there's huge pricing hits. Let's just maybe say that in terms of like, if you have an investment property, that's one thing, right? The rates are higher than on an owner occupied loan, but then you layer in multifamily, there's hits, you layer in cash out, you start to get to high leverage cash out multi investor, you're paying pretty high rates compared to what you pay owner occupied on the Fannie Freddie stuff for sure.
So now when the gap is closed between the difference in pricing between these two loan products, and then you compare the actual process of getting the loans closed, I mean, there's really not even a reason to go conventionally, all other things being equal. I mean, just the speed of closing. And honestly, the way I like to look at it is, if you asked a borrower, what kind of program do you think would make sense for a rental property? They would come up with some common sense things, which is exactly what this program is.
Sure.
Okay, I have good credit, which shows I have a responsible borrowing history, like looking backwards, and then the property's got good cash flow, which means there's good collateral looking forwards.
Right.
And so those two things combined, that's not the only things we look at, but those are the two main drivers.
Sure.
And which is why we wanted to dig. Obviously everybody knows what credit score is, but we wanted to dig into that cash flow component.
Yeah, because it's frustrating for these borrowers when you have multiple properties and then you on a conventional and you ask them for you need every statement, all that with taxes included, insurance, all this stuff. It just becomes an underwriting kind of nightmare. But also the other thing is like the blanket loans. And Cory, I know you've been kind of having some success with clients. I mean, that's a nice feature, right?
Yeah, from what I gathered, not every, even community banks are in favor of doing blanket loans, and I didn't realize how many lenders out there don't do them. Or don't do them, and maybe it's increasing now a little bit, but maybe that's another niche the market was kind of calling for a while.
Sure, and I mean what that means is essentially doing one loan cross collateralized across a bunch of properties, and that's something that a lot of investors are looking for just from simplicity standpoint, to have one loan payment and not have to worry about having 10, 15 different loans outstanding. So I think that's been a pretty good thing too.
So let's dig into the actual loans themselves. So as we said, one half of it is the credit score, and obviously just like a conventional loan, higher credit scores can offer a little bit better rates or significantly better rates, for top tier borrowers. That said, we still lend to average or even lower credit scores in certain cases. But the other half of that is the property itself, and this is really what the loan's based on. What is the cash flow of the property? And so to do that, lenders look at what we call debt service coverage ratio. You'll see it abbreviated DSCR. Sometimes they'll just say debt coverage ratio. And in my experience, historically, just having dealt with community banks and on commercial loans, they're typically looking at a 1.25 debt service coverage ratio. And do you want to explain like kind of what that means? What is a 1.25?
Yeah, sure. Essentially what it is, it's the debt, the pity payment, the PITI, or if you have a condo association, dues as a percentage of the actual rent on the property. And and I even would say in commercial banks, commercial properties especially, but commercial, local community bank lenders, sometimes the formula is even higher. It might even be like a 1.3 or 1.4. So if at a 1.2, it essentially means that the rent is 120% of the debt on that property. So if your pity payment is $1,000, taxes, insurance, everything all included, we want to see, or most banks want to see that the rent is at least $1,200. Where we'll go, if you want to segue into that we'll go a little lower on that.
Yeah, I would say, and pity payment being your principal and interest with your taxes and insurance, and then like you said, if there's a condo.
Yeah, condo dues or flood. We don't look at maintenance or anything like that, or a vacancy factor. Where a lot of banks will then haircut that.
I was going to bring that up. Yeah, so they might have a higher debt coverage ratio. They might want you to get to a 1.25 or a 1.3. And that also includes whatever formula they're using. So it might be your payment plus taxes, plus insurance, plus a vacancy factor, plus they might set aside money for maintenance or whatever else is the case. Not only do we not do that, we have a lower debt coverage threshold overall. So we're really just looking for that 1.1 number. in most cases. So,
which is pretty aggressive. Yeah. And then, people ask about, the seasonal rent. We typically want to see a year-round lease, but, we are now, post-COVID. During COVID, it was really tricky because a lot of that, Airbnb, VRBO rental stuff was kind of, you didn't know how that was going to play out. But now that the market's coming back, we are starting to look at vacation rent as a way to cash flow these properties too, which I think is pretty exciting. And especially for borrowers that focus in those vacation areas. They could kill it from a rental standpoint compared to a year lease. So it's great that we're, kind of able to start analyzing those deals too and helping those type of, borrowers and deals.
I'm thinking by the time this podcast is probably released, we probably will have a vacation rental product to be talking about.
Yeah.
And again, these loans are 30 years fixed, amortized over 30 years. So even though they are technically commercial loans for residential properties, unlike your local community bank, this is not like a 5 or 7 or 10-year balloon payment where the loan comes due in 5 or 7 years and you have to either refinance or sell. This is like set it and forget it. It's a self-liquidating loan, 30-year term, 30-year amortization.
And if the cash flows work now, the argument is, obviously, rent should continue to increase. You're paying down your debt, property value going up. It's all part of, I think coincides with the master plan for a lot of these investors. And, even just a segue to that, so it's like what's the power of this product, right? What's exciting about this for investors? How can they utilize this to, create their, increase their worth? And, when we have borrowers that, it's life-changing for them. This is how people are, buying properties to save for their kids' college fund or, build out their, retirement plan or whatever. If you guys want to talk about that for a second, one, we talk about the Burr method, with values increasing, if people can find something that they could buy, put some money into it, fix it up, we will then, pretty much, almost right after they've acquired this property, we'll be able to look at the new value and lend off that. So if in a lot of instances, people are buying a property, fixing it up, we're able to cash them out with this new 30-year fixed loan. And a lot of them are able to take most, if not all of their basis out of the property. So now you have none of your own cash in the property and it's cash flowing. It's just a home run.
And think about it from a new investor's perspective, right? It might take you a while to save up $50,000, $60,000, $80,000 to get started in the real estate game, especially here in the Northeast where properties are just more expensive. So to save up $80,000 and go out and buy a rental property that's stabilized, that might be a good investment. But now you're back at zero, and you have a little bit of cash flow each month, but now you have to save up money again. So this Burr method really allows you to recycle your money, right? You could buy a property that's beat up, fix it up, increase the equity. And we only require 6 months of seasoning to use a new appraised value. So once, by the time you fix it up and you put a tenant in there, you're either at 6 months or pretty darn close.
Sure.
Now you're going to refinance, pull out not only your down payment and your renovation money in many cases. Sometimes you can pull out a little bit of extra money based on how much you've improved that property. And now you're ready to go do it all over again. And so you're recycling the same money over a 6 or 12-month period and build the portfolio that way.
Yeah, and totally making numbers up. This would be like a slam dunk deal, but what that looks like is, let's say you buy something for 100, you put 50 into it. At that point, your all-in cost is 150 plus any holding fees. But let's say it appraised for 300 on the ARV. Well, after 6 months, we're looking at that 300 is what we're lending off of, and go up to 75% of that on a cash out. So obviously that's a home run deal. They're not all like that, but in that scenario, you can pull out all your.
Yeah, but even if people are able to, pull out the bulk of the money that they use for down payment, and maybe they're still out of pocket some of the renovation cost or whatever, they could factor that into their model, and they're not out that 25-30% of the acquisition price. And like you said, Anthony, buying that turnkey property, so now you're paying top dollar for it, and you're out of pocket 25-30% on that higher dollar amount, where now if you're buying it lower, you're putting that sweat equity into it or getting it fixed up, and like you said, even if you're able to get the bulk of it out is huge. And then also for our borrowers, like what we're seeing is there's been I'm one of them. I have a couple legacy loans or properties on my books where, you have people who bought things during the 08, 09, pre-bubble. And then, things really kind of, obviously we all know what happened and values decreased, and now things are starting to come back. So, there's, I think, investors who've been sitting on properties for a long time, might have been stuck in some higher rate loans that they were never able to refinance because they didn't have the equity, and it's harder for them to qualify as a self-employed or somebody who owns rental properties. And now finally, not only does this product allow them to access and qualify for these loans, they're finally, the equity's there. You know what I mean? So they're finally able to get out from maybe under, and now the cash flow is tremendous for them. Or they're people that just, now they realize that maybe they've had the equity and they just couldn't get the financing, and now they're able to access that capital and then go out and buy other properties. It's just huge.
And what I can't stress enough is kind of what you touched on a little bit is like the actual underwriting process of these loans. We do conventional mortgages as well, and it's just like, I know we mentioned it before, but it's like until you actually experience it, it's just night and day.
Yeah.
My favorite question from the borrower is like, what am I missing? Like, the rate's great, the terms are great, the docs you sent me, the list of docs I need is like, I could do that in 20 minutes. Like, what am I missing here? And you're not missing anything. It's common sense lending. That's why the product's been so amazingly popular. And there's many markets around the country where they're cash flow markets, right? The spreads based on what you're buying properties for and what they're renting for is high, and you can, relative to what you're getting in rent, you could buy these properties very cheaply. The one thing I wanted to point out was in our area, like in the Northeast, some investors are looking to buy like more of like a future like appreciation play. Mm-hmm. They want to buy in the path of progress. They think that this town or this market's picking up. There are cases where for with better credit and lower leverage, we can even go below that 1.1 debt coverage ratio, even all the way down to even cash flow, or at low enough leverage, even negative cash flow, which is a really cool idea for the right borrower.
Yeah, that's a really, really good point. Like New Jersey especially, right? Like our Jersey investors out there, I mean, the taxes are just, so expensive. So it's hard to hit that high cash flow sometimes. But yeah, to your point, you just think that, but that being said, it's in a great town where you feel like it's more of a price appreciation play. You're okay getting even money or even a little bit less because you just know that, you just feel really confident that the values of the homes are going to go up over time. So, we have that we'll look at it a little bit differently. But, for those investors, and we're starting to expand our footprint geographically, and we're doing a lot more deals in other parts of the country. It's funny when you see like, these really, they're getting really solid rents, and, we laugh because we look at some of these deals where the property taxes are like, $2,000 for a year, where
$980,
and it's awesome for these investors. I mean, we're giving them a great product, and they have tremendous cash flow. So that's cool stuff.
I mean, that's more or less the product. It's been far and away like the darling of what we've been doing the past few months. I think investors seem to love it, and just wanted to get some clarification on what it is we're looking at with these loans and why that debt coverage ratio is important. So
yeah. And what would you say like best? I mean, anybody listening out there, I mean, some of this stuff might be second nature, but some newer investors, some of this terminology, I know we're kind of going over it real quick. What's the best way, for them to reach out to you guys?
One thing Cory and I do a lot is we direct borrowers to the website. We put together a really nice rental property calculator where you can actually go in there and put whatever scenario you want, whatever leverage, whatever rate, purchase price, taxes, insurance. It'll show you not only what the debt coverage is, so you see if the deal works as far as a lender underwriting it, but also what are your return metrics, your cash on cash return, and all those sort of things. So that's a great way to do that. And then if you want to just reach out to us, I mean, fefunding.com is the website, or 732-359-7800 is our main line here, and any one of our loan officers would be happy to talk through a scenario with you.
Yeah, and by all means, just reach out. Any question, no question's a stupid question. We'll help you understand the formulas and everything you need to be looking at, so that way to help you analyze your deals.
Or if there's some that caught your attention that we kind of just glazed over that you just have a general question on. I mean,
just bounce something off us, and happy to look at a scenario. So
yeah. All right, thanks everybody. Thanks for listening.
Catch you on the next one.